Welcome everyone to the webinar. I'm really excited to be here today with three colleagues who I think will share really unique perspectives about what 2025 has to offer. While it's 3 weeks into the year, I think we all agree that it's still fresh in our minds what this coming year will be like. We just had a new president inaugurated on Monday, and I think many of us are still writing 2024 on our checks, which is how you kind of gauge whether you're used to the new year or not. So. Excited to be here with my co-panelists. My name is Adam Goller. I run Fintech Banking at Cross River. I've been here for 17 years, since the beginning of the bank. And maybe just to get things started, each panelist will give an introduction of themselves, a short bio, as well as sort of their views on how 2024 was, which will then set the tone for how we can talk about 2025. So from my perspective, I think 2024 was sort of a tale of 2 different years within the same year. The first half of the year felt very much like 2023 in many ways, in terms of rates being stubbornly high, capital being stubbornly tight, perhaps ongoing regulatory impact on fintech bank partnerships, and really not much different than the prior year. And then we started to feel things change toward the second half of the year, seeing some better collaboration across the industry, changes that perhaps some line of sight to changes in regulation, some lightening up of capital on the sidelines, and some rate relief across the board. And so I feel like the second half sort of set up what I think will be a really, really good year, 2025. And so with that, maybe I'll turn it over to my fellow panelists to introduce themselves, maybe starting first with Joe.
Thanks, Adam. Happy to be here. My name is Joseph Garba. I'm the head of external affairs here at Cross River. I've been with the bank for just under 3 years now. Before that, I spent most of my career in local, state, and some federal government. To piggyback off what you just said, I think from my perspective, as far as in the federal government and the regulatory level, last year, it's similar to what you said. It was kind of a tale of 2 years. I think we're not making any news here. I think if we say in the fintech industry, in the Bank-Fintech industry, it was challenging at the regulatory level. But I think really the beginning of last year was kind of the capstone of the crystallization of what we have seen as an increasingly aggressive, some may say hostile regulatory approach towards fintech, and that includes bank-fintech partnerships. I think the good folks at Klarna and Klarna in particular had a graphic up early last year that showed that banks that partnered with fintechs were almost 11 times more likely than traditional banks to have some sort of public enforcement action. That's huge. That's staggering. It was, I think a lot of folks will say, a directed effort to dissuade folks in the fintech industry and from banks from partnering with fintechs. What we saw also is a Congress and a lot of folks who took note of that. I think you would see it, especially in the House Financial Services Committee, the majority of folks last year. A lot of rank and file members and leadership wrote letters, asked a lot of questions at hearings of the regulators about why this was happening. I think their concern is they support this industry, they see the benefits, but more so they see how it affects their constituents. I think they have a lot of consumers in their districts who use these products and benefit from them. And so to see that go away or to see that chilled at the regulatory level was something that was concerning to them. And so going into the second half, we saw a little bit of a dip in those enforcement actions. Some will argue about why that was, whether it was just they had hit everybody they could hit, or whether some of that public pressure actually started to do its job. And, some of the regulators did decide, hey, let's take another look at this. Let's slow down. Towards the end of the year, we did see a joint agency rulemaking on bank-fintech partnerships. So that also was something that we look at it coming into 2025. We look at that. We try to take the positive and say, okay, look, maybe that was a marker where we can start to turn things around with the new administration coming in. But yeah, I think that was the way we ended last year. Was okay. Let's see if we can kind of pause some of the hostility. Let's see if we can try to foster more communication, collaboration, and so we'll see where that takes us in 2025.
Great. Maybe I'll pass the baton to Noah.
Thanks, Adam. So Noah Cooper, I'm Cross River's Chief Investment Officer and head of our Capital Solutions Group. I've been here for about 6 years. Prior to that, I was at a another fintech student lending platform, and before that, at BofA Merrill in their structured products group. To answer the question of 2024 recap, echoing similar themes that Adam and Joe, I think would describe it as that we saw the light of the tunnel was indeed a light and not an oncoming train. And the four areas that I'll highlight there are markets, corporate health, consumer credit, and policy. As Adam noted, well, it was more back-ended. We did get 100 bips of rate cuts. Somewhat counterintuitively, at the same time, the 10-year did back up 50 bips. All the while, though, credit spreads did tighten meaningfully, and this all comes together in the form of lowering borrowing costs, which is definitely a headwind, tailwind, excuse me, for our industry. The next is corporate health. We definitely did see an overhang of bankruptcies in 2024. I think it was the largest number since 2010. At the same time, we do think that was more a function of the sharp macro move in 22 and 23, as opposed to ongoing and persisting problems. So we do anticipate that number abates going forward. The next is consumer credit. With the population of folks that we work with in the marketplace lending industry, they were deeply affected by higher rates and higher inflation, and charge-offs reached all-time highs throughout 2023. In 2024, we did see that reverse quite precipitously. We ended the year at this lowest level in charge-off rates in nearly 2 years, and just 100 bips higher than pre-COVID levels. And then lastly, on the policy front, I think from our perspective, while inflation really does weigh on our minds and the balance with the new administration, it's more than offset than the pro-business administration that we are entering into 2025.
Great. Well,
hi, everybody. Hillel Olivestone. I am head of strategy and corporate development at Cross River. I've been with the company with Adam since the beginning. So it's been a wonderful time. I'm in charge of developing the overall company strategy, various initiatives, a lot of external sort of market analysis and data gathering, M&A venture investing, and I run something called basically our CVC, called Cross River Digital Ventures, where we're investing in companies from seed to Series B, and work very closely, obviously, with everyone else on this panel and across the organization. 2024 was an interesting year, as you've heard, and try not to repeat a lot of what was said, obviously in agreement with a lot of the themes that we have talked about. It seemed going into 2024, a little bit of an up and down 2023, but a little bit of, from a bank, fintech, banking as a service bank partnership relationship perspective, a lot of momentum, a lot of banks looking to get into this space, and a lot of fintechs looking to expand their offerings and working with financial institutions like Cross River or any other banks getting into this space. And then, as Joseph highlighted, the regulators sort of hyper-focused on this space and came down with a heavy hand across the board. And it was a little bit of a wake-up moment across the industry, from the bank perspective of every bank thinking, this is simple, I'm just going to get into fintech banking and banking as a service and work with fintechs and start bringing in revenue. And then other fintechs just saying, yeah, I can launch any product when I want to and work with a bank, and it's an easy access to be able to serve customers. We obviously feel very strongly about how things should be done. And the industry sort of, as I said, had to wake up to the realistic expectations across the board of what banks need to be doing and what they were requiring of their customers, and what fintechs need to be doing to actually serve them. So as we go into 2025, I think things are set up pretty well. As we said, rates are coming down, credit sort of reached a point where we're getting to see the light at the end of the tunnel there and some improvements. And now there's been, as Joseph highlighted, expectations of how to actually do this properly. So the ones that I wouldn't say that they're fakers, but thought there was an easy way of doing this, have sort of backed away, and the establishment of the proper fundamentals and way things should be done. So I think we sit here pretty excited about the new regime coming in and how things are set up for 2025.
That's great. So I think that's a great summary of 2024. I think the word I would use going into 2025 is certainly the word optimism. But I think that means different things for each of you on the call, from a strategy perspective, government perspective, and maybe from a capital perspective. So maybe focusing on that for each of you. When I look at 2025, I use the word optimism carefully, but at the same time, maybe each of you could go through how you think that impacts you and what do you expect to see in 2025 in your respective areas, maybe starting with you, Noah.
Yeah, I think just hitting on the capital point, obviously bank lending pulled back considerably 2022 and 2023 and leaking into 2024, given higher rates and uncertain credit outcomes. If you look at the end of 2024, however, and you look at the bank senior loan officer surveys, respondents were no longer in a position where they were tightening credit standards, and demand for loans, reached back to a neutral level. Given this dynamic and given the pullback we saw in previous years, one would anticipate, a real acceleration in bank lending. However, we really only saw sort of like a paltry 2% year over year in bank lending. The underlying factor that leads me to believe that's driving this is the uncertainty that existed around capital rules. Obviously, there's been a lot of talk around what Basel Endgame looks like and what those implications will be, especially for the larger banks above 100 billion. I think looking into next year, if we want to see that real acceleration of lending, we do need clarity around those capital requirements. And if you look at Travis Hill's speech a couple of weeks ago, he addresses that point head on and says he's really in favor of a capital neutral approach, which I really think should be really right for banks to feel like they have a playbook to resume lending.
Yeah, and Hillel, maybe from your perspective, how do you think that the regulatory environment could help shape 2025 to be positive and optimistic the way we're describing it now?
Yeah, so I think there's been some things from a regulatory perspective that obviously, we're in a little bit of a tough position, right? So we want innovation, we want to make sure in collaboration and expansion of the fintech ecosystem and system as a whole. But at the same time, we need to support regulation that is supportive and does the proper things across the space. And one of those things was obviously, highlighting specifically the Synapse Evolve situation, the regulators coming in and requiring the banks to have proper oversight of the ledgers and everything that when you're handling the end consumer and customer. Obviously, at Crossover, we built our own technology. If you don't know, we built our own core systems, and that allows us to have complete oversight on system relationships. Even in the off-platform situations, we have specific guards in place to make sure we have the proper oversight as needed, and that's something we obviously feel positive about. So, as we mentioned before, there are certain regulations and certain things that come into place that give us the playbook of how we should be handling the relationships going forward. And that, I think, as we now have that positively, we have the playbook in place and we know how to act, and everyone knows how to work in this space. Touching on a couple other points, from an M&A and venture perspective, we are still seeing a lot of dry powder on the side from a venture perspective. There are different things that people are getting excited about, which I'm sure we'll talk about. But we are still seeing now more interest and more capital being raised to invest in this space. From an M&A perspective, I think we thought we would see this huge wave of M&A and consolidation over the last few years. It comes and goes. And at this point, I think companies are getting into the right space and understanding the future with more clarity and more optimism, and we can see some acceleration in that area as well.
All right, great. And for Joe, for you, I want to get a little hyper specific here because I think it's important. You obviously have expectations what you expect to happen from a government perspective in 2025, but focusing on how it actually would specifically help the bank-fintech partnership in your mind, and maybe touching on it as well as like, what is that right balance? Like, in the prior 4 years, perhaps people view that the regulatory environment was overly onerous on these partnerships. And obviously we don't want the pendulum to ever swing too far. And so in your mind, how can we strike the right balance in 2025? And what do you actually expect to see?
No, Adam, that's a great question. I want to build off what Hillel was just saying, because it's a very important point about the right level set for regulation. I think, to quickly answer the question and come back to this, I think what we'll see in this year is more openness. And when I say openness, I don't want folks to feel like it's the wild, wild west. Like Hillel said, everybody thinking, I've got the best product, I can just get a bank partnership and I'll be launched in a week or a month and I'm good to go because we're in a more open environment. Regulation is very important, and it's not something we shy away from, as Hillel just described. I think we pride ourselves on, being able to comply with what's in front of us, and being able to set up our system in a way that it is safe and sound for consumers, because that's what it comes down to at the end of the day. I think the pendulum you're describing a lot of the times, and I don't want to say Democrat, Republican, I just say folks on both sides of the conversation about bank fintech partnerships is risk versus opportunity. And I think a lot of folks, many folks choose to focus on, well, this is a very risky industry, and I'm going to focus on the risks and make sure I'm doing everything I can to minimize those risks, even if it means tamping down the growth of the industry. There's another set of folks that say, well, there's a lot of opportunity here, and there's risk in anything you're going to do. And so how do we balance that risk to make sure we're maximizing the opportunity for consumers so that they have the access to the products and the services they need and want and haven't gotten, in the past. And so just to kind of level set the conversation, because I think a lot of folks look at the new administration coming in and saying, oh, it's going to be, all open doors. We do have a history of, this first time in history where we're having a new administration coming in where we have a 4-year example of what that administration is going to look like. And we also have as far as banking, we have a new Congress. We have a new head of the House Financial Services Committee, and we now have the Republicans taking over the Senate Banking Committee, in the Senate, and Senator Tim Scott chairing there. Financial Services Chairman French Hill, who I think industry folks will tell you, I don't think we could have asked for a better leader, to take over that committee from Patrick McHenry, who was also very positive on this industry. French Hill's a former banker, knows these issues, has already kind of put out his platform of what he thinks things should look like. So what I envision, what I see is going to happen is, and again, I think Noah just mentioned Travis Hill's speech. We're still waiting to see what some of the other potential regulatory agencies will look like at the top. We're still waiting for some of those appointments, but we did see Travis Hill, who's been the vice chairman of the FDIC, who's now been appointed the acting chair, give a speech last week and also put out a statement earlier this week when he was appointed, laying out his vision. And he talked about a lot of the things the industry has been trying to voice for years, that regulation is important and the bank regulator relationship is very important. It shouldn't be punitive. It shouldn't be, I'm looking for anything you're doing that's wrong. It should be, how can we collaborate? How can we work together to make sure we have the right set of regulations and that banks and fintechs are aware of what's expected of them, so that when the examiners come in from the regulatory level, banks know what's expected, they know how to comply because we want to comply, and that the examiners know what they're looking for. I think that's where we may need some work and some help, is how do we make sure we're modernizing those regulations to meet where we are today. I don't want to get too much into examples, but there are regulations from 30, 40 years ago that just don't make sense for what's being done in the traditional banking system and in the bank fintech partnership industry now. And so how do we foster that conversation to make sure we're looking at these things in the right way? And the RFI I described earlier that the agencies put out at the end of last year, I think should be a good starting point. We had almost 70 people, including Cross River, respond to that RFI with our thoughts on what bank fintech relationships should look like, describing how we do it and how we think we do it well, and other folks weighing in on what that should look like. So I think building off that, fostering a more collaborative conversation will be important in this year. And I think that's what we'll see, is when I say openness, again, it's not the Wild Wild West. It's, I think, a group of regulators and legislators in Congress who want to look at the opportunities and figure out, okay, how do we safely maximize those opportunities?
Exactly right. You use the word collaboration, which is the right word, and I would add the word transparency. I think collaboration and transparency, the two of those together, should create the right environment. Maybe one thing we were the beneficiaries of is that we got some questions submitted from the audience prior to the webinar, and so rather than waiting until the end, I'll sprinkle in some of those questions while we go to make sure the audience gets responses to what they've asked us to respond to. So focusing on one and maybe sticking with Joe for a minute, the question submitted was, have there been any interactions with the agencies regarding the examination process and how some changes might be coming with the new administration?
So we haven't had direct conversations with the agencies about the exam process, but again, I don't think it's a secret that folks view some issues with the exam process. And I'll give you the perfect example is, Congressman French Hill, who's now the chair of the Financial Services Committee, introduced a bill that had been introduced in the Senate the prior year. He introduced it last year, called the Fair Exam Act. It's a piece of legislation that would review, and you use the word transparency, would give more transparency to the bank exam process. It would, give banks a little more transparency into what's expected of them. It would create an independent agency, actually, that would work with regulators to review how they're going in and doing the exams, review the exam determinations, and also review and reform the appeal process, which, again, I think folks who have gone through that process can give you their feelings on how fair it is, how independent it is, how real of an appeal process it is. So that piece of legislation, again, it's just a marker that folks in Congress are hearing from the banks in their districts, they're hearing from the banks across the industry saying, this process is not working for us. We want to comply, but it feels like we're playing a game of gotcha where we try to do things the right way, but folks come in and say, well, you've been doing this and you shouldn't have been doing this before. We know you asked us about it. We didn't get back to you, but you shouldn't have been doing it. So now it's gotcha. So I think giving more transparency to that process, we're hoping, conversations like the conversation around the Fair Exam Act will help cultivate a little more reform there.
Great. And maybe to give one more question from this section that was submitted, and maybe to go a little bit away from the regulation aspect of this conversation. I'll start with Noah on this one. The question submitted was, do we expect to see more IPOs in 2025? And maybe, not all IPOs are created equal. Certainly the IPO environment from 2021, 2022 is likely not to repeat itself. But maybe addressing the question of IPOs, Noah, starting with you.
Yeah, I think we definitely will see a pickup in IPOs. Obviously, there has been a dearth of IPOs in the last several years for several reasons. But if we look at where we stand now, valuations in the public sector have reached a level where it will start to become interesting for folks to raise public equity capital. S&P forward PE ratio is hovering around 23 versus the historical mid-teens type level. And I think in addition, you have like general CEO confidence. If you look at some of the survey metrics, that is quite a bit higher than it's been in a number of years. And interestingly enough, it last was at this level at the beginning of the last Trump administration, and that number continued to rise, that confidence level throughout 2020 or back in 2016. So I'm of the belief we should see quite a few companies IPO that have been waiting in the wings over the last several years.
Great. And Hillel, from your perspective, obviously, IPOs are one of the ways where companies can raise equity versus, let's say, M&A or just private raises. And what's your view on the IPO market generally for 2025?
I mean, for fintech specific, there's been a few companies sort of waiting in the wings that people have expected to actually go public, Stripe being obviously the biggest. But we've seen Chime and Klarna and others either publicly, privately filing. So I think there's full expectation that these companies will go out there and go public. They've reached a level of maturity at this point that it logically makes sense. Stripe has always talked about staying private and the advantages of doing that. We're a private company. We've always obviously found some of the positives of staying private, but there are obviously positives of going public as well. And as the M&A activity and having that public currency becomes more advantageous, as we said, we're not specifically talking about the regulatory environment, but that environment comes a little more favorable. We'll see more companies taking advantage of this route. So fully agree with Noah and fully expect that this activity will pick up significantly.
Okay, great. All right, shifting now fully away from regulatory for a minute, focusing on product trends and trends in the market and growth trends. I was saying before to someone internally that it feels like to me we're shifting away from a pure product focus to a customer-centric focus, meaning in the past, you wanted to offer a payments product or a payments rail, you focus on offering the rail, and you were somewhat agnostic to the customer who used that rail. I think now we're seeing a lot more focus on a customer profile serving a segment. So that's one thing I noticed from a trend perspective. Maybe starting with Hillel, since Hillel runs strategy and product for Cross River, what are some of the trends you're seeing from a product perspective or from a customer perspective, whether it be in consumers, small businesses, or other areas, from your perspective?
Yeah, so continuing a little bit of some of the things that we talked about before from a bank fintech partnership relationship. Let's say you're a fintech and a large fintech, and you want to offer a various product or service. Previously, what you would have done is you would find a bank to cater to that specific product. So let's say you want to offer money movements or payments, you would find the bank that would be able to be your best suited for that specific product. And then if you wanted to expand your wallet and ownership of that customer and wanted to offer lending, you'd go to another bank that would be able to, that specialized in lending. With everything that's happened over the last year or so, it's become more important, and we have at least seen because of the customers that we're catering to and the companies that we're talking to, that companies want to be able to work with one institution for a multitude of products, but you don't want to then obviously have a backup for each one of those products. So you want to work with one or two banks that can offer you the most services across the board. We obviously pride ourselves in having the ability to offer lending, payments, cards, issuing, accounts, capital markets, and investment banking all in one house and one platform. And so that's the trend that we have been going towards, and really making sure that our products and services cater to the wide variety of clients that we're seeing, and not customizing specifically for specific clients that we may have done in the past.
Yeah, it makes sense. And I think Noah, obviously, capital availability has a direct impact on what products people offer and can offer. And certainly you mentioned before the impact of inflation, other factors that are macroeconomic on the customers that we serve or our customers serve. And so in your mind, like what trends do you expect to see in terms of who fintechs and banks are able to serve perhaps going forward?
Yeah, and I know we're trying to get away from the policy one, but I'll bring it back to that. I think the ingenuity in our world continues to persist around what are the types of consumer finance products that can be offered to various consumers outside of just what we deem to be traditional finance. Some of these products that serve a considerable utility for a certain customer segment, we view as responsible products, have largely lived in this regulatory ambiguity and gray area, and obviously capital inflow to those types of finance products has been limited. A couple that come to mind would be earned wage access and home equity agreements. Those are two important products that we think really do serve an underserved population. And in the past, these have lived in this unclear area of what they're how they're defined. We're fairly confident that this new administration will give us further clarity around what those products should be and how they should be regulated. And we have a really nice concrete example, tying it back to your earlier question on solutions. Current is a client of Cross River Bank, where we provide a multitude of solutions. We're the company's card issuing bank. We have a credit facility to them. We help them raise outside capital, and we provide their banking as a service products for them. And as the administration changes, they offer an earned wage access product that we were able to lean in confidently to help finance. So a very concrete example of us being solutions oriented and how it's giving us more confidence given the policy changes to be able to support these products that we deem as high utility, high responsibility.
Yeah, and Joe, that's a great segue. I think for you, like getting clarity around some of these products that previously lived in the gray is really important because it'll make them more universally accepted in the market. And I think you won't have banks hesitating to facilitate those products. But maybe from your perspective, what are the areas that we would expect to see growth in going forward, perhaps buoyed partially by some of the regulatory or administrative changes that are coming for 2025?
Yeah, I think I agree with my colleagues. And I think specifically, Noah pointing out EWA, this has been a conversation that's been growing, evolving over the last couple of years at the state level and now more so at the federal level. A product like that where, folks are arguing across the country how to even define it. Was it a loan? Is it not a loan? I think conversations like that, I think we'll start to see some more leadership from the federal government on and some more guidance coming down about how these should be categorized. So I think a lot of these, as Noah called them, gray area products. Like I said earlier, I think there'll just be more openness to look at what's the opportunity with these things. Is there something there? Let's see what the risk is, but let's also look at how can we create a framework around these things that allows them to operate in a safe way so that consumers have the option to utilize them if they would like to do that. I think that's the sort of collaboration we'll continue to see, and that will lead to growth and more products and more folks wanting to say, okay, I can try to introduce something new, because there will be openness from the regulators and from Congress to allow its use. And so that sort of collaboration, I think, is what we'll see over the coming year. I think particularly for us, the way we're looking to try to harness that collaboration, our CEO, Gilles, wrote an op-ed last month kind of outlining what he'd like to see happen over the next year. One of the asks in that is that the regulators, they all had innovation offices of some sort over the last couple of years. They've been utilized and less utilized at times. In Travis Hill's speech, that was one of the things he mentioned is, I'm going to reinvigorate my innovation office at the FDIC if I'm chosen to lead it. I think seeing that happen across the board would give that voice at the regulatory level, somebody who's looking at these products, somebody who's more familiar with them than maybe, your traditional examiner or, just traditional agency, middle manager, really taking that innovation eye to these products and how do they work and how can we best utilize them. Working in collaboration with industry, we're hoping that these innovation offices will work together, but also pull in industry. We've always been asking for a seat at the table to discuss these products and figure out together what do these frameworks around them look like, so that we know what we're doing when we operate them, but also the regulators are comfortable with what that framework looks like. So pulling that conversation together in a formal way with these innovation offices to have an ongoing dialogue, an ongoing back and forth about all of them over the year, I think would be crucial and would be very helpful to the regulators, because again, then you are ahead of it, understanding, hearing from industry, this is what we like to do, this is why, this is who it'll serve, and then working together to come up with those rules of the road, I think benefits both sides and benefits consumers most of all. And so the hope is that we'll see that formal collaboration take place over the next couple of months to allow for that product growth.
Yeah, totally agree. And Joe mentioned before about a lot of banks previously trying to get into the space. And Hillel, I want to get one question from the audience directly to you. It was around banks building their own technology to support some of these products. I think one thing that we can all say on this call as employees of Cross River is that we were sort of ahead of the curve, build our own technology for a very holistic, wide breadth of product that we offer to the market. But obviously it's super expensive. And obviously the view on middleware is pretty negative given the debacle that happened last year, without going into detail. And so thinking about how banks can actually participate in this space with the knowledge that building the technology in-house can be super expensive, yet using a third party or using middleware can also be, a nightmare.
So I wish I had an easy answer to that. It's not simple, because see, at the same time, we're advocating for your own technology. We're advocating for offering multiple products and services. So we don't believe, and we strongly don't believe in sort of, I wouldn't say half-assing it, but like, we don't believe in just going part of the way. Like, you either have to be all in this business or not. And that's the way to really do it the right way. But there are systems out there, and we're seeing some of the legacy companies get into this space and offer different services. Fiserv, FIS, et cetera, have made either various acquisitions into this space and trying to offer tailored products and services to legacy platforms and legacy institutions to enter banking as a service and enter the fintech banking relationship space. So with that, because all of these banks, either most likely, if you're not building your own technology, you're using one of the 4 or 5 large legacy platforms and core processors out there. So that is one way that you can get into this space if their products are sufficient. The middleware providers have pivoted from working with fintechs and working directly with banks themselves. I think it's TBD to see if their technology is sufficient from a scalability perspective and tailoring to what the regulators want based on the scrutiny that has happened over the years. So I wish I had an easy answer as to how to actually do this. But there are some offerings out there that can get you part of the way. And then I think we do believe strongly that it is a required investment of your own institution from either not just technology, from a process standpoint and people standpoint of how you actually go about and do this.
It's expensive to be a bank today, that's for sure.
Yeah.
Okay, moving on to our next section, which is talking about the Bank-Fintech Collaboration. So I think we want to focus now on some factors that influence that collaboration. Obviously, we've covered extensively the regulatory impact on this collaboration, maybe moving away from those regulatory impacts and focusing on the actual operational integration and working with those folks. And maybe, Noah, you work with a lot of fintechs in the work that you do. You've seen differentiation between folks who are better at that partnership than others. And in your mind, what are the factors in your mind that can drive better collaboration going forward and sort of like differentiating what I'll call the better from the less good in the space?
Yeah, I think it's long-term thinking from the outset. All the best partnerships that we've had, the long-term implications of every action that we're taking are thought through up front. And the ones where we've had more headaches have been more of an incrementalist approach to how we think about integration. And just, speaking in particular for myself on the capital markets and advisory perspective, having that really clean performance data upfront will make the capital markets, accessing the capital markets several years down the road, all that much easier. It's really a tale of two stories. Sometimes we're playing cleanup, we're trying to wrangle together data from multitudes of sources, cleaning the data, and it really just delays, that platform's objectives and goals of accessing markets versus those who are really spend time upfront thinking about infrastructure, thinking about what are the questions that I'm going to ask from a rating agency or institutional investor several years down the road. We've really seen those folks, having much more prolific relationships with them.
Yeah, that makes sense. And Joe, I have a feeling I know how you're going to answer the question, a similar question, but there's some banks that want to be in the fintech space for maybe just a deposit product to raise deposits or for other more specific reason. In your mind, what creates a good collaboration between a fintech and a bank, from your perspective?
That's a good question. Look, I think it's all about collaboration, having the right fit, as you just said, okay, if it's just a deposit product, who's the right bank for me, where are they regulated, what's their relationship with their regulator? I want to make sure, I think what we're doing as the bank is providing that regulatory clarity and honestly the regulatory operation for that fintech partner. So, having the right partnership is, making sure it's the right relationship, but also making sure that your product can be regulated in the right way, and that bank has the, right relationships with their regulator to make sure that, it's the thing that the fintech doesn't have to worry about. They can innovate, they can create, they can, operationalize their product and not have to worry about, that sort of back end, everything that we're doing for our partners.
Yeah, that makes sense. Go ahead.
Yeah, just to add there, I think the relationships and Adam, you're much closer to this than I think than all of us. When you're going through a due diligence process with various fintechs, specific criteria that we sort of require off the bat sort of help us know which ones are the real players and which ones are sort of haven't really thought through everything that they want to do. When you're speaking to a team on the other side from the fintech that has really knows what they're talking about from a compliance and oversight perspective, it's a real different relationship where things can get stuck in the mud from an onboarding perspective, and where you hit stops in the road and just sort of you would have expected to be onboarded in 60 days, let's say, and it takes 7 months, is because things were not necessarily thought out through, and the two sides didn't come to a meeting of the minds and understanding of how the product actually is going to work and get launched. So it's extremely important that the fintech has that expertise in house. Even if you're a young company, it's worth making that investment from a compliance and oversight perspective, because that will help you down the road infinitely, and you will save a significant amount of cost by getting to market quicker. On our side, obviously, from a technology perspective, we have to do everything we can as the bank partner to make it seamless as possible, either from a due diligence perspective and technology integration perspective, to make sure that time is not really extended, and making sure all questions are answered and oversight is being done from an onboarding perspective properly.
Yeah, I think one kind of key word we've not mentioned until now in this conversation is open banking. And I think that one thing that I think people have to adjust to in the world in general is that this idea that people will stick with one bank for every product they want to take. Like in the old days, I'm sure my parents' generation was that you had your bank accounts and your mortgage and everything with the same bank. And now with open banking, and I think the innovation of products, people are very comfortable, pursuing different products with different financial institutions. And so that will continue probably to be a trend going forward, and that will require then product innovation from both banks and fintechs together, but be more open to the fact that money will move between all those different products and institutions. And so I think that's another point that we haven't covered yet, but was brought up by one of the people in the audience, and I think I wanted to make sure we covered. So maybe to touch on something Hillel alluded to, which is also on the agenda for today, is that speed. If you ask a fintech what differentiates a bank partner, they'll oftentimes talk about price, right? And price is the focus, like who's the cheapest. And I would assert that has proven to be the wrong strategy going forward, or in the past at least. And going forward, I think what I've seen resonate, not that price isn't important, but it's the technology that the bank offers to the fintech. It's the, to Noah's point, shared goals that you have with that fintech. And so when I think about what it means to speed up the process, because that sounds scary. I mean, if Joe's sitting here and hearing, we're going to go much faster on onboarding new fintechs, that sounds pretty scary, because it is a complicated diligence process. There's a lot of regulation that you have to go through and diligence you have to perform. Yet I think there are ways through both product and technology that Cross River in general and others are using to speed up that process. So when I think about, maybe keeping it with Hillel for a second, is leveraging like systems and process to accelerate that process. How can we facilitate better onboarding and accelerate the process to onboard a fintech from a bank perspective?
Yeah, so I mean, when you think about price, it's not necessarily how much are you being charged on the one product that you're doing or the various products. So let's say we're doing card issuing with a fintech, and we're also doing ACH and RTP. It's not about how much each of those costs, but it's really the in total invested costs from the fintech across those different products. And that's why we feel strongly that having everything on one platform creates efficiencies and cheaper for the customer across the board, right? So fewer amount of audits, fewer amount of oversight, quicker onboarding from one product to another. So let's say we onboard you for an ACH payment product, and now we want to onboard you for card issuing. We obviously have a lot of that information already, and not asking you to go through an entire due diligence process. Again, the integration with Cross River or similar situations where you're integrated into our platform gets you integration and onboarding and be able to launch a different product as well off our platform. So you don't have to spend a significant amount of engineering costs again to get those products launched. So when we think about it, we think really, really long term when we're working with fintechs, whether you're a small fintech hoping to become a large one or a large one hoping to grow even bigger. It doesn't make a difference to us. We are creating systems on our end, and that's our focus, to create a more efficient process across the board, whether it be technology, compliance, oversight, et cetera, and launching different products and services. We try to make it the most efficient way possible across the board.
Yeah, and Noah, certainly when you think about someone who's looking to get debt or equity, raise capital, anything in the public or private markets, I think you think about a very manual process, long timeline, could be 6, 8, 9 months. So when you think about how Cross River or banks that are offering these products can accelerate diligence and onboarding of these fintechs, where can that be differentiated?
Yeah, I think similar to what I noted earlier, that like having that really good upfront infrastructure, both in terms of how you think about manufacturing the asset, to product, to pricing, to data and availability, because a lot of the way we evaluate the pricing of these various arrangements from an investor perspective is you're always indexing to past vintages. And the challenging part is once you have a couple of bad vintages, they stick with you for a while. And even if you've made those enhanced changes to your underwriting model, oftentimes we won't see that bear fruit for 12, 18 months or so. And so it's just getting back to that, trying not to cut corners, thinking long term, because all of these things will sort of be on your permanent record, for lack of a better term, for quite a bit of time.
Yeah, that makes sense. Maybe shifting again, I also want to make sure we answer some questions from the audience as we head the last 15 minutes of the webinar. Getting even further away from regulatory discussions. The next section is really around M&A, and Hillel talked about this earlier from an M&A perspective, general deal activity and capital markets activities. So Noah, you have an interesting lens. You not only, are the CIO and run a lot of the warehouse facilities we offer, but also under your purview, we have the investment bank. And I think that, it's been very hard to raise even private capital. We talked about IPOs earlier, talked about some M&A, but maybe you can give us a kind of your outlook on from a capital perspective in general, on how folks can think about the process to raise capital for 2025.
Yeah, I think similar to the IPO question, I think we do anticipate quite a bit of M&A in the next chapter, and the driving factors there. One, similar to the IPO comment around multiples are starting to look more attractive, and large public companies are able to more attractively raise capital for acquisitions. The second being, I think we're going to have a more friendly, antitrust regime that we're entering in. A lot of the discussion that we have with folks is, why start this incredibly arduous, long and expensive process if I'm only going to be stopped at the goal line? And so I think there should be more sensible and logical thinking there as it relates to overseeing, whether acquisitions are blocked or not. And then the last, which, as I noted at the top of the call, we have seen an uptick in corporate bankruptcies. I think a lot of that may be liquidity driven, the sharp rise in interest rates. But I do think there's a lot of really good companies out there who haven't been able to raise capital and are going to be really high quality opportunities to be acquired by larger companies who don't have that capital raising problem in this next chapter.
All right, great. Let's have some fun now a little bit. There's some keywords we didn't really hit at all. I'll throw out two. I don't think a webinar in 2025 would be complete without mentioning AI. In addition to that, we've not used the word crypto or stablecoins or blockchain in this entire webinar. And so with 12 minutes left, I would feel incomplete if we didn't go down that road. So Hillel, starting with you, obviously, Cross River does a lot within the blockchain and crypto space. To some extent, we're using AI, but maybe clarify for the audience, where you see the uses of AI, specifically focusing on the Bank-Fintech partnership, and then maybe you can at the same time cover your view on where you see stable coins or uses of crypto or blockchain being used within this partnership as well.
Yeah. So 3 years ago, everyone was a crypto company. Last year, everyone was an AI company. This year, everyone's a stablecoin company. So someone's going to be a crypto AI stablecoin company. So I'm sure they're out there. From an AI perspective, or just AI in general, obviously, I think we're going to see more innovation in the space that we've highlighted already. So across the board, either whether it be regulatory or banks themselves, utilizing AI in different ways. From where we sit, I think we think that from a KYC, onboarding, fraud, and underwriting perspective, all of those different things, we're going to see applications of AI. Hopefully from the regulators will become more open to utilizing them, but we do feel there's definitely applications there. We are looking at AI everywhere we possibly can across the organization to automate and innovate across the different things that we are doing, and specifically around fraud, compliance. I don't want to say we're implemented yet. We're still applying it and trying to find the best use cases specifically. Now, from a stablecoin, look, it's the hot thing right now. Where we sit and what we do, we are immensely focused on domestic. We do have some international offerings as well, and we're looking to expand that. And that's where most of the stablecoin application has been, and where we've seen adoption so far, and where I think most of the applicable use case actually is. Domestically, I am skeptical of seeing where stablecoin actually can be utilized at a larger rate. There's a lot of talk of replacing the different networks, Visa, MasterCard, et cetera, with stablecoin use cases and knocking them out, but they provide a certain need and certain advantage to the consumer. And in the end of the day, if the consumer is not going to be taken care of in the use of stablecoin, look, these are business models that are being innovated right now. I'm not so sure I see the adoption there with RTP, FedNow, and other real-time applications. I'm a little skeptical of stablecoin making a big dent in domestic use cases. That being said, I think there are ways that banks like us can definitely play a role, whether it be working with the various stablecoin companies in the US right now. Potentially, maybe a bank issues a stablecoin, and you have to decide, would I, as a holder of that stablecoin, be more comfortable with an FDIC insured institution issuing that stablecoin specifically and directly, versus having a middleman in the middle basically saying those funds are one-to-one, or so they say, at a regulated institution. So there may be a play there that lends credibility and more comfort to the space. I think it's all to be determined. I think it's very exciting. As we've highlighted, there's a lot of innovation to come. There's more openness to innovation. So I'm sure we'll see all these different topics, AI and stablecoin, et cetera, all come together to create the next phase of financial innovation.
Yeah, I'm going to shift to Joe, but Joe, I'm going to be very cognizant of the fact I want to step on a landmine or go down a rabbit hole. Maybe just at a high level, obviously there's a lot of talk, in your world about AI and about crypto and blockchain, and maybe just give us your perspective on how that conversation is progressing, and where you see that landing in 2025.
Oh, thanks, Adam. First of all, I want to say that I find it very appropriate that it's in the last 10 minutes that these words came up, because as Hillel said, 2-3 years ago, everyone was a crypto company. I think for a bank, after the crypto winter, it became a forbidden word, for the last year or so. And I think coming into 2025, folks are starting to take another look at it. I think, members of Congress are looking at it. Stablecoin in particular, former Chairman Patrick McHenry, this was a passion mission of his to try to adopt a stablecoin framework legislation. I think that will continue. I think that was a bipartisan effort, last year. I think that effort will continue. I know one of the questions we got was, what date will we have a stablecoin bill, signed by the president? I don't know that I can forecast that, but like I said earlier, I think the openness to these issues will come back at the regulatory and congressional level, especially now with the Senate turning over. I think, Senator Tim Scott has always been open to innovation. Getting votes out of the Senate is a little more challenging than in the House, and I think both majorities have very slim majorities. So, there will be negotiations about these things, but I think these are topics that will be back. It will be topical. I think, they no longer will be forbidden conversations. I think folks will again freely explore what the opportunities are there. With regards to AI in particular, I think we saw an AI executive order by President Biden a couple of years ago. President Trump had said he would undo that and put something new in place. I think, we're waiting to see what that will look like. But I think the difference we'll see for sure is there will be more allowable use cases for industry, I believe, is what we'll see. What that will look like, as Hillel said, I think all responsible banks are looking at how can we use this in a responsible way. Folks are still, again, exploring, because there hadn't been that green light, go conquer. I think what we'll see now is a framework that's being built around allowing financial institutions to actively look at how they can utilize AI in their everyday practices. I think there'll still be some concern about using it in actual originations and in ways that will impact consumers, and making sure that we're not completely trusting the machines to make those decisions that impact actual consumers. So there'll probably still be some caution there, but again, I think overall you'll see more openness to allowing industries to look at how they can utilize these products.
That's great, and we're getting to the last part of the segment, and so I have one more topic we'll cover. But before I do that, Noah, on AI, I think there's a lot of utilization of AI in the world that you cover that I think people are less cognizant or aware of. Maybe touch on AI and how that's used in your world.
Yeah, I view it through two lenses. One, what is the practical application of AI in our world today? And then the second one, what is the byproduct of this AI boom in terms of company formation. In terms of practical application, at some point in the future, we may get a world where Gen AI is doing ABS deals from cradle to grave, and all of us are out of a job. But I think in the here and now, it's really about productivity augmentation. David Solomon was quoted a couple of days ago saying 95% of an S1 can be done by AI agents in a matter of minutes. If I think about the world that we operate in, we spend a lot of time combing through legal docs, trying to find, what are the remedies for a trigger breach, et cetera. And I'll give one very, silly example that we Cross River are working on LLMs to explain credit performance. And so we were advising a company who was going through diligence, and the question was asked to the company of, you perform welcome calls for some segment and you don't perform welcome calls for another. Counterintuitively, the population that received the welcome calls actually underperform. And we spent hours and hours and hours of days like trying to uncover what were the driving forces behind this. But if we had an LLM at our fingertips, that's something we could be answering in a matter of minutes. On the company formation side, I think we're very keenly looking at the enhanced need for things like cooling system companies, data centers, and how those companies are financing themselves, both on the equity and debt side, and thinking about what are the areas that we can serve them on an advisory side.
That's great. Okay, so I think we have time for one more question and final thoughts from each of the panelists in 30 seconds or 45 seconds or less. I think topics we didn't cover, which I think are still open, are things like embedded finance and cross-border payments. I would say I've always thought that embedded finance is sort of a misnomer in many ways. People have thought that we've already achieved some sort of embedded finance, and I still view true embedded finance as being, finance that's embedded in the apps we use every day. That's social media, Facebook, Instagram, X, Twitter. So to me, I think we're at the very tip of what embedded finance will be. And that kind of ties into what I think will be the future of payments and cross-border payments specifically, because I think that those apps, many of them are really universally used. And so for me, when I think about 2025, I think it's a year of progress on all fronts, but I think it's really a year we'll see an advance in embedded finance, true embedded finance. And I think that will drive payment innovation, not just on the payment side, but across digital banking and bank-fintech partnerships. So maybe going back to Hillel to end off, final thoughts, any things that I've talked about you want to leave off the audience with as a final takeaway?
Yeah, one of the questions that we deal with internally, and we've seen some movement in the industry here, is how far up the stack of services between what a fintech offers or even a non-fintech and what the bank offers does the bank go? Like, where is that breaking point or the end point between the fintech and Cross River or any other bank partnership? And I think one of the things that we're seeing as embedded finance, as you highlighted, probably continues to expand, and we see more partners coming in there. We may see banks wanting to do more for that clientele. The fintech industry likes to own as much as, in most cases, most of the process. But these clientele in embedded finance will probably not want to do that. And so we might see more banks going up the stack farther to do more of the services that were once sort of as part of the requirements of the fintech or other partnerships on the other side. So that's one of the things I think that we're trying to contemplate, and that we may see a movement in the industry in that direction.
Great point. No, why don't you finish off, then we'll go to Joe.
Yeah, the one buzzword you left out, Adam, was private credit.
Oh, there you go.
With this private credit boon and more large private equity companies owning insurance capital, right now the supply demand of assets is definitely shifting. And while investors are still being discerning, they are not enough fixed income assets there to meet the demand. So my prediction for next year is that it's going to be more of the year of capital partnerships and JVs versus the attacking deals on a one-off basis.
Love it. Joe, why don't you wrap us up?
Very quickly, I'll just wrap this up by saying there's opportunity. I think innovation will be not a bad word in 2025. I think it's something folks will look to again to say, okay, how do we simplify things? How do we make things more efficient? How do we provide more for consumers. I think at the congressional level, how to provide more for our constituents to make sure their needs are being met, because at the end of the day, that's what, you know, elected officials care about. So across the board, I think we'll see more openness, but again, just to caution everyone, openness doesn't mean the wild, wild west. I think we all still believe in responsible banking, and I think that's what the industry will allow us to do.
All right, great job. Thank you everyone who joined and submitted questions, and I appreciate everyone's time, and have a great day.